BlackRock is buying ZIM integrated shipping services. The company increased their holdings in ZIM by 12% over the past quarter. What I'll do in this video is I'll go over some things you need to know about the stock. I'll go over short interest, I'll go over the financials, and at the end of the video, I will give you a price prediction for the stock. So we saw BlackRock increase their holdings by 12%. And we also saw Citadel increase their holdings by 500% over the quarter. And we also saw Advantis International Small Cap Value ETF increase their holdings. When we look at State Street did sell somewhat, but it's very crucial to point out that BlackRock, the largest asset manager in the entire world, is buying more of this stock. Yes, this is likely the company simply right-sizing their portfolio, but it is good to see that this asset manager, the largest asset manager in the entire world, hasn't thrown in the towel on this stock yet. And then with that being said, let's take a look at the company's short interest. Then I'll go into the company's financials. So the company has a short interest as a percent of float, which is about 18%, roughly 19% if you kind of rounded it up. So that's obviously a large chunk of the float there. And also we have days to cover of 7.4, which tells you that it takes 7.4 days of average volume to cover the shares that are sold short. So this signals to me that this stock has a high likelihood of a short squeeze. Typically, when we're looking at days to cover, we look for a days to cover of over 10 to signal a high likelihood of a short squeeze. But given we're at 7.5 and we have a very high short interest as a percent of float, I would say this company has a very high likelihood of a short squeeze. So when we take a look at what Fintel thinks, so Fintel ranks out every single stock in the market and gives it a grade based on short interest squeeze likelihood. So in this scenario, in this stock, I should say, Fintel ranks it as 397th in terms of most likelihood to have a short squeeze out of the 4,500 companies that they rank. That puts it in the top 9% of companies for a high likelihood of a short squeeze. So definitely Fintel thinks that this stock has a high likelihood of a short squeeze. Another reason that would be is because the short borrow fee rate is at 10%. For those that don't know, this short borrow fee rate tells me what a company, what investors are charging to lend out their shares to short sellers. So typically this is anywhere from 0.3% to 3%. So that's kind of the average range. So to be over 10%, to be 3 times the average rate signals that it's expensive to short this stock, which could help cause a short squeeze. Obviously, as less shorts would be willing to short the stock given its high cost to do so. So with that being said, short squeeze is somewhat likely for the stock. And then let's dive into the financials for this company. So we can see here that they have a PE, a GAAP PE over the past 4 quarters of 1 times, which is pretty good. It's well below the sector median. And then EV to sales is at 0.5, which is well below the sector median again. And then price to book ratio, this company looks extremely attractive. So we have a price to book ratio of 0.28. So that basically tells you that the assets on its balance sheet are, not nearly worth, are worth 4 times the amount of the current market cap. So that tells you that this company's trading at a deep discount when you look at its price to book ratio. And when we take a look at their historical price to book ratio, we can see that they have a historical price to book ratio of 2.2. So this really signals that this company is trading at a massive discount relative to its own history. And that 0.28 price to book ratio is extremely attractive. And when we just take a look at growth, we kind of understand why the valuation is what it is right now. It's because growth has been so poor. That's why the valuation is so low. So revenue growth is at minus 41% over the past 12 months. And this pales in comparison to ZIM's 5-year average growth of 79%. And then when we take a look at the revenue growth for the next 12 months, we're seeing another 20% drop in revenue growth projected over the next 12 months. So yes, revenue growth is still negative over the next 12 months, but we're seeing this decline kind of taper off, which would obviously be a good thing for the stock. And then let's take a look at the profitability metrics for this company. So we can see that their gross profit margin is 46%. For those that don't know, gross profit is basically just revenue minus cost of goods sold. It tells you what a company makes for what it sells. So 46% is a pretty decent number, and it is well above the sector median. Unfortunately, it is below ZIM's 5-year average of 56%. And when we take a look at net income margin, it is another solid number. So we have a 16% net income margin, which is more than double the sector median, but is unfortunately below ZIM's 5-year average. So when we take a look at these numbers, they look pretty solid, right? The profitability and the valuation look good. The growth looks obviously pretty poor. So that's kind of why the stock has such a low valuation right now, is that the growth metrics are very poor. And let's take a look at this company's balance sheet. So this company has $1.9 billion in cash, which is roughly $8 billion, which is roughly $8 per share, $8.65 per share, which really shows you that this company is actually only trading at roughly... So they have about $2 for their equity. So you're basically paying $2 for their equity when you consider that cash position for the company. So, so about 80% of their market cap is in cash, which signals to me that this company has a high floor and really can't do much wrong with that massive cash holding. So 80% of the stock is in cash, and we can also see that the company has debt of $4.8 billion. So they have $2.98 billion more debt than cash. But this is a capital-intensive business, so it isn't shocking to see the company having more debt than cash. And then when we take a look at the profitability metrics compared to other firms, we can see that this gross profit margin is actually one of the worst amongst the peers, which we don't love to see. And then net income margin is actually the worst amongst the peers. So revenue growth as well, we can see that the 5-year compounded annual growth rate is actually at 20%, which is actually above most of the peers and right in line with the general sector. So not horrible growth over the past 5 years. It's just the recent growth has been very, very poor relative to peers and relative to the company's own history. And then when we take a look at the PE gap for the past 12 months, we can see that this company trades at the lowest valuation compared to all peers. And then on a price-to-book basis, we actually trade at the second lowest valuation to all peers, with NMM being slightly cheaper. So on a valuation basis, we rank out really good compared to peers. On a growth basis, we obviously look poor, based on the past 12 months. But when you kind of take a step back, you can see that this company has been trading or has been growing very fast over its history. And then profitability metrics were basically, kind of on the lower end of our peers. And the balance sheet looks strong. We have a strong cash position of $8.65 per share in cash. And then we can also see that this company was upgraded by JP Morgan just last week. So JP Morgan upgraded the stock to overweight from neutral with a $15 price target, saying that the temporary nature of ZIM's company-specific challenges is not appreciated, with a natural runway for cost competitiveness to improve over time. And then they also say that over the past 2 years, ZIM has moved from leader in profitability to having the worst profitability metrics in the sector. Then JP Morgan also says, we view this as temporary, expecting the company's cost base to become more competitive as new build charters and delivered at competitive prices and expensive COVID era charters are either redelivered or rechartered at cheaper rates. So JP Morgan becoming bullish on this stock just last week. Let's take a look at what Wall Street thinks about this stock as a whole. So it's really a battleground stock. So we have three different investment firms that are bullish, two different investment firms which are bearish. So we saw Barclays maintain their bearish rating, their underweight rating, and lower their price target to $10.60 in about mid-August. Definitely a battleground stock. We're seeing a wide range of opinions and price targets for this stock on Wall Street. So with that being said, let's take a look at the chart and give a price prediction for ZIM here. So obviously shares have traded massively lower over the past 12 months or so. The stock is trading right around its IPO price at around $10.50. So right around that IPO price, will this stock continue to fall and fall significantly below the IPO price, or will we hold this IPO price and kind of use it as support? That's kind of the real question for the chart at this point in time. So we're coming down to, I kind of want to call it support, but unfortunately we've already broken this level. So it's tough to call this IPO, which was at exactly $11.40. Now that we're below that IPO price, which kind of acted as support back in June as shares moved higher, now that we're below this level, unfortunately, I do think the stock, from a technical standpoint, is likely to continue lower. How low? It's a really tough one to call because there isn't any major level of support for this stock to kind of catch some buying demand, but at the end of the day, the stock is almost oversold according to RSI, which could lend additional support. And, to be frank, I do think this stock, from a fundamental standpoint, is a really good one to own. So at the end of the day, yes, the technicals don't look great. I wouldn't say this is a technical buy. I wouldn't say the chart is screaming a buy whatsoever. But like I said, I really do like the fundamentals, the financials of this company. We're trading at a massive discount when you take a look at price to book. Therefore, I do think this stock is a pretty decent long-term hold, and I am in agreement with JP Morgan's thesis that the selling of this stock is a bit overdone, and the drops in profitability, the drops in growth are likely to subside and reverse for this company. So I like this stock long term. I hope you enjoyed the video. I will end it there. If you got some value from this video, please leave a like. We post company breakdowns and important market moving news on this channel on a daily basis, so make sure you are subscribed. If you would like to receive my daily portfolio moves, my exits, my entries, and see how me and my team of analysts are trading the markets, join the Discord through the link in the description below to get our free 7-day trial. Also, if you would like to join our free daily newsletter, sign up to our Substack, which is linked below as well. With that being said, good luck everyone. Happy trading, happy investing.